Well, good morning, everyone. Thank you for taking the time out this morning to join Mark and I on a BDO webinar, an Eyes on Tax special. My name's Ian Craig. I'm BDO's Eye on Tax for obvious reasons, and a reminder that the webinar's just popped up on my screen. So we're all go today, and I'm joined by Mark Lauder, my great friend from Christchurch. You want to say hi, Mark?
Yeah.
And today we're going to take you through, we've had a bit of a change of plan, and we're going to change what we were originally going to do, because we started out with an invitation saying that we would cover a few different things, and that was on the expectation. We didn't think there would be any major tax changes in the budget 2023. And while there wasn't, significant tax reform, there was a very important change in the tax rate for trustee income to 39%. And Charlene, if you can just move. Yeah. So what Mark and I have done in the last couple of days, just because of the sheer interest out of, well, what is the impact of this 39% change in the trustee income rate, tax on trustee income? We've decided to simplify our topics that we will cover today, and we're going to focus on the trustee rate and that change. We're going to talk a little bit about the High Wealth Project, which in some ways this 39% change is a catalyst to that, and we're going to think about an eye on the future. We are welcome to receive any questions. The format for the questions is for you to put it up on the chat box, and Jamie will, in the background, will get those questions to us, and we'll probably address them at the end of the session rather than as we go through it. So one of the things we learned from some of our previous webinars is if Mark goes first, we sometimes run over time, and so he's been kind enough to let me take the lead on this particular presentation today. So I'm going to kick it off by looking at...
Just quickly, Ian, because I can't help myself. If you look at the red lines and the strikes through, all of those topics were the ones that I was going to talk about. So there is a hidden message in here for me from Ian, and thank you very much. Over to you, Ian.
Yeah, I'm good at making more work for myself. So yeah. Look, budget 2023. I guess the headline was that there was a change in the tax rate for trustee income at 39%, and a tax bill was released on the same budget day, which contained a number of other pieces of legislation, particularly our adoption of the OECD Pillar 2 reform. So this is basically turning around to try and put on a global minimum tax take. It's a response to all the sort of base erosion, profit shifting requirements. It's legislation that's relatively complex in its application. It's really applying to the really big players and making sure that they're paying their fair share of tax in New Zealand. And just how that will unfold is probably a topic for another conversation rather than today's presentation. But it really is going to affect the majority of the very large multinationals. There was a very helpful change for timing of lump sum receipts. So if an individual had a dispute with ACC or MSD in terms of a benefit that they were due to receive, and it took some time for that award to be granted, you would receive a lump sum, and of course the lump sum is income in the year in which it is received, therefore it's taxed in that income year. And say it might be 2 or 3 years worth of back payments, that would be taxed potentially taxed at a higher tax bracket than you would otherwise expect to have if you'd received it over the 3 years. So they've introduced a much welcomed change to allow a mechanism for calculating the average tax take on that lump sum payment. And so that's a welcome change. The last point in this slide is the Tax Principles Reporting Bill, which is a little bit of a sneaky one. That the I might call it a David Parker special, where he has sneaked a reporting bill into Parliament for consultation, designed at trying to set some principles and legislation for assessing the fairness of our tax system. And I'd ask Mark to maybe comment a little bit more on this bill.
Yeah, thanks, Ian. I think many of us have used the word sneaky with respect to the taxation principles reporting bill. As Ian said, it's about promoting fairness in the tax system and to improve public understanding, promote debate, discussion, etc. I think the first thing is to note is if this is passed, it becomes primary legislation effective from the 1st of July 2023. And it actually does outline, what principles make a good tax system. So what would be your generally accepted tax principles to promote fairness, etc. in the tax system? We've got some of the principles we've got horizontal equity, so people on the same amounts of income should pay a similar amount of tax. Efficiency, so it should tax system shouldn't be too distortionary to the economy and use of resources. We need to have vertical equity. That's your progressive tax system at play, and I'll talk about that a bit more in a second. Revenue integrity, so it needs to make sure that we don't have avoidance, evasion creeping through, etc. Compliance and admin, we don't want to be spending a huge amount of money on compliance and admin in the tax system. It needs to be certain. Businesses need certainty, and we want to have flexibility and adaptability in our tax system. Now, all very valid and interesting points, but I think in particular, if we refer to the notion of vertical equity is about a progressive tax system, and it does appreciate that not all taxes need to be progressive. For example, GST is a regressive tax, so you pay the same amount of tax regardless of what income levels you are on. So vertical is the more you earn, the more tax you pay. But what they've done here is they've actually brought in the concept of economic income in this particular principle. That is, tax is progressive if persons with higher levels of economic income pay a higher proportion of that income in tax. That's a principle that we're going to measure ourselves against. Now, at the moment, I would have thought it's fairly clear that we would fail on this, and we'll talk about the high wealth individual project in a second. But it is saying that in practice, wealthy people should at the very least pay no lower a rate of tax on their economic income than middle income New Zealanders already do. Now, if we're looking at the concept of economic income, which we do not tax, at the moment under current legislation on the whole, then in terms of that being a goal that we are seeking to achieve in promoting fairness in our tax system, then we're in a fail situation year on year unless something changes. So it does feel this is the sneakiness that's creeping in. It's almost a fait accompli if we don't see more changes like increased tax rates or new taxes, because each and every time we measure against that principle, it is a fail in that box. Just in terms of measurement, the act, or the bill refers to effectively a 3-year cycle. So every year, the commissioner has the ability, or will be by legislation required, to collect data. It's a first 2 years in a 3-year cycle is an interim report. It's a lesser report. The 3rd year it goes into more detail and gives a full report as to what's going on. Possibly it looks like a data gathering exercise. It may evolve, but that's where we are on the taxation principles reporting bill. Sorry, very last comment from me. We have until another sneak, the 9th of June. To make submissions. We don't have much time, team, to get your thoughts across as to whether this bill is good, bad, indifferent, or needs some changes. So that's the taxation principles reporting bill, Ian, from my side.
Yeah, no, thanks, Mark. Look, I think it's an interesting development. It's a question of whether it's actually needed. at all is one of the questions I have. Is it just an increase in regulatory? It's not a taxing act. It's not there. It's there to sort of framework or provide a framework for government policy on tax. And I think that's interesting with the media release from David Parker, who said that successive governments have made changes to the tax system in the name of fairness, but without facts. The idea of fairness can be subjective and manipulated to suit political arguments. I think that's a classic statement, and I'm sure there's many of the previous governments would have disputed that they had set tax policy without having reference to facts. And of course, the question of fairness and equity is, it depends on who's looking at it and from what spectrum, etc. So, look, I think it's a data gathering exercise. It's going to allow them to capture the sort of information that they have been capturing through the High Wealth Project that was undertaken last earlier this year. So, and on that point, I'll just pass you back to Mark to maybe comment just on that initial results of the High Wealth Project.
So if we can move on to the next one, Charlene, please. So the High Wealth project undertaken by Inland Revenue, well discussed in the media of late, and has, arguably, well, it's dominoed into these two changes. So the trustee rate, which Iain's going to move into, and the taxation bill that we just talked about. So the headline rates are that after looking at economic income, so very broadly, we'll have a look at what were you worth at the start of the year and what are you worth at the end of the year, and then determine what your effective tax rate is on that gain. So for the super high wealth, we're at 8.9%, and for middle wealth New Zealand, we're at 20.2%. Now that's, there's various emotive headlines and discussions that the super wealthy aren't paying their fair share of tax, etc. One of the mischiefs being the ability to shelter taxable income in trusts at lower rates. Again, Iain's going into that. And the other part of the mischief, I think, is quite apparent in terms of the taxation of economic wealth, is within that taxation principles reporting bill, very much front and centre in one of the schedules. It talks about the vertical equity that persons who are on higher economic wealth should pay more tax than those on lower amounts of economic wealth. So we're already there's quite a gulf, 8.9, 20.2, if you are benchmarking against that type of measurement. So look, the High Wealth Project, we would have been very, very surprised, given there's a huge amount of wealth that's not taxed in New Zealand, to see a result other than one which is high wealth lower than middle. Otherwise it just wouldn't make sense. So the answer was staring in the face before we'd done the actual research. I guess the question is, where to next on all of this? So look, it's over to Iain on 39% and trusts.
Yeah. Well, look, I think when the High Wealth Project was started, there was a suspicion that this was going to lead to, a creation of a capital gains tax or a wealth tax or some form of punitive tax that would tax property holdings or large investment holdings. So in some ways, the change to the trustee tax rate to 39% to align it with the top marginal rate is a low-hanging fruit that the Minister, Grant Robertson, was able to implement. Now, there's lots of commentators who would say that they expected it to happen. Personally, I didn't pick it. Maybe I'm just getting a bit lazy and sort of getting a bit fed up with the fact that there's not that many tax changes announced at budget time these days.
Iain,
but I also...
Can I just... Sorry, I'll just jump in, because I share your view on that. I didn't expect it either. Normally, and you look at what the national government are doing, and I know you'll talk about that later, but in a lead up to election, it's not ordinarily expected that we have increase in tax rates. But anyway,
yeah.
back over Iain.
Yeah, no, we keep the powder dry for the election campaign. But look, it was an easy one to implement, and the key date is it starts from the 24-25 income year. So for most trusts with a March balance date, that will start from 1 April 2024, and we'll come to some of that, assessing some of the impact of that. So a trust, just to set the scene, a trust is a tripartite relationship between the settlor of the trust, who gives some money over to the trustees, and the trustees look after that money for the purposes of the benefit, for the benefit of the beneficiaries. And they can only do that in accordance with the terms and references of a trust deed. Currently, beneficiary income is taxed at the marginal rate of the beneficiaries, so that could be anywhere from 10.5% through to 39%. And if income is retained in the trust, and not distributed to the beneficiaries, then it's taxed at 33%. And that's the rate that will change. And it will go to 39% from 1 April 2024. So I think it's important to really understand what is beneficiary income and what is the type of beneficiary distributions that can be made. So beneficiary income is income which is distributed or paid to a beneficiary. That could be a cash, a physical cash distribution. It can be income that's maybe not paid out to the beneficiary in cash, but allocated or credited to the beneficiary's current account in their financial statements. And that might be a current account where, depending on the terms of the trust deed, it could be seen as something that the beneficiary could call upon to be paid out to them if they were, and beneficiaries do have the right to see the financial statements of a trust, or at least the right to ask for them. Or it could be some form of sub-trust arrangement where really the trust funds are allocated to that beneficiary early on. You can also have a situation where income is allocated for a beneficiary to possess at a future date or event. And an example of that might be somewhere where a trust is set up, a set of money is allocated to a beneficiary, but they can't get access to that money until, say, they reach the age 21. And trustee income is basically every other form of income which is not beneficiary income. So whatever income the trust derives, it needs to be allocated into either beneficiary income, which is taxed at the marginal tax rate, or trustee income, which is taxed at the trustee rate, which is going to change to 39%. Now, one of the things with trustee income is that once the trustee income has been taxed at that 39% or 33%, the funds can be distributed out to the beneficiaries without any further tax. It's not an imputation system, it's just an absolute, it's a tax-free distribution to the beneficiaries at that point in time. So there's an obvious advantage in having the income tax at 33% and a year's time or 2 years' time being distributed out to maybe a high-earning salaried beneficiary who's on the 39% tax rate and getting a 6% saving there. There's a couple of helpful exemptions in this change. One is for deceased estates, and that's where they're recognising that under a lot of wills, it's maybe a trust is created when a person dies and the estate is formed, and that's in the nature of a trust, but it may be difficult because of the terms of the will or the property that's involved for it to be decided how to be distributed out of the estate to the beneficiaries. So there's an exception there which will result in a sort of averaging of the tax that would have been paid had the person who deceased still been around, still been alive, versus that top rate of 39%. So it's recognising that an estate cannot distribute the income, so therefore it's going to be taxed as trustee income. It shouldn't be taxed at 39%. There's also an exception for disabled beneficiary trust. So this is where a trust has been set up specifically to provide for an individual who's got a challenging circumstance, and there's certain rules around that, but again it's an averaging of the tax, because it may be that that person is unable to receive that income because they maybe don't have the ability to deal with it. Now, trusts, so there's apart from the income splitting, trusts remain a really good vehicle for intergenerational wealth and protection of assets, and I think that We should never lose sight of that. From a social policy point of view, the difference between beneficiary income and trustee income is ignored. All of those distributions are captured in social policy legislations. So whether it's a working for families, entitlement, child support, or student loans, it's all kind of blown through. So that's a good policy from that perspective. So you can't have trust fund babies living off working a child support or getting some benefit from the state while still receiving sort of tax-free distributions out of trustee income, etc. So just moving on to the next slide.
Sorry, Ian, it's me again.
It's a conversational presentation, man.
Just in case anyone's scratching their heads, Ian is talking about complying trusts. We're not going into any technical detail regarding non-complying and foreign trust, etc. Many of you may have experienced the distribution from foreign and non-complying trusts as being taxable, but if they are complying trusts, as Ian said, distributions of accumulated wealth in the trust shouldn't be taxed. So yeah, just to be very clear, complying trusts.
Yeah.
Sorry, Ian, back again.
No, good. Mark's now taking on the role of my watchdog. So keep me on this, keep me on the straight and narrow. Keep me on the script. So I'll see if I can put him on. So look, one of the interesting things in the information is just this little graph here, which is showing a tracking of dividend income to trustee income. So the top line, solid black line, is trustee income, and you can see that the dividends from trusts to which are taxed as trustee income typically are kind of follow the same pattern. And beneficiary income is kind of relatively even, and so that's indicating to the revenue that they have people are using trusts to save the 6%. And while that's true, I think they sort of say that trusts have been deliberately used to get round the top tax rate, which I feel is a little bit disingenuous, because trusts are used to hold capital appreciating assets, typically the family business, shares in the family business. And if that business is successful, and one would argue that the growth in those numbers has been through the growth in the economy, and dividends are paid out, then it's going to the right place. And the reason that the company is held by a trust is that if at some stage in the future the business is sold, then the capital that's been generated by the growth in that business and from the eventual sale should end up in a trust, because that's where you can pass on that wealth accumulation onto your next generation of family members without it going through to unsecured creditors, or potentially the trusts are useful for making sure that your daughter, the wealth that you've created, doesn't disappear to if your daughter marries a rat bag or a drug dealer or somebody of ill repute, etc. So there's still a fantastic vehicle from that point of view.
Ian has 2 daughters, I believe, so he's referring to daughters.
Yeah.
Not sons.
I've got a son, but he's self-sufficient, so he's all right. So yeah, I'm not worried about him. But a couple of things here is there is a spike, obviously, in 2022 to 2021, where there's a lot of dividends were paid out before 31 March 21, when the 39% tax rate was introduced. So that's no surprise, and that will come when we talk about what might happen.
Yeah, this slide isn't a surprise at all.
No.
I came to New Zealand many years ago now, and I was surprised then. Surprise is the word of the day. How many people had trusts? So it stands to reason that your dividend income is going to follow your trustee income quite closely, especially when you've got a higher marginal rate if it goes to the hands of the individuals. The interesting part of this slide will be in the next few years. Fully expect to see beneficiary income spiking and then leveling out. So 180 is going to be the new 70. Beneficiary income is often used to mop up lower marginal tax rates than that of the trust, as long as the individual's got lower marginal tax rates as well. So I think we should see a spike and then a leveling off of that as well going forward.
Yeah, I think the revenues focus through 2000 through to 2020 when was that trusts were being used to get around to 39%, and I think the concern expressed now is about the dividends flow being paid, but in fact the real problem with the trust back in when they first went to 39%, which I can't remember exactly when that was under the Cullen and Helen Clark government, but was personal services income, and they were certainly focused on people not paying tax on their personal services. And I've got a view on that trusts are generate some of the dividends that are generated here are not from personal services, it's from the assets that the trusts have generated and accumulated over time. So let's just move on. So let's have a look at what so you might be sitting there thinking, right, I've got 39% trustee rate. Surely the easiest thing for me to do is going to be distribute a dividend from the trust to a company. And here I've got a slide that's showing a company which is typically 100% wholly owned, and that's ABC Limited, 100% wholly owned by the family trust. So could we distribute a beneficiary distribution to that? And then, of course, the company tax rate is 28%. So I've potentially saved 11% on income there. If the company is associated with the family trust, but maybe owned by a person, I could distribute it to that company. Now, aside from the fact it's always difficult to get money out of a company tax-free to the beneficiaries, the revenue are alert to this potential planning situation. And so, as you'll see in the next slide, that this is going to be a complete and utter no-no. In fact, they will say that if you've distributed profit from the trust or trustee to beneficiary, a corporate beneficiary, it will be taxed at 39%. And I think if you follow that through, there's going to be a mechanism which will be complicated just because of the nature of the mechanism to sort of allow imputation credits to be potentially paid out at a different level, because it would be ridiculous to have a company paying tax at 39% and then only able to pay a dividend out with a 28/72 imputation ratio. So I think that's one of the details we need to work through in that. I guess my own observation would be that we have had a reduction in corporates as beneficiaries of trusts over the last 20 years through when the debt forgiveness clawback rules were introduced, which could capture, which Mark will talk about in a minute, but there was a lot of trust where the companies were removed as potential classes of beneficiaries. So this sort of practice wouldn't necessarily be that common. And Mark, do you want to jump in at that point?
On the having a corporate beneficiary of a trust.
Yeah.
It can, like clothing, in the context of tax, natural love and affection can right many wrongs. If you stick a corporate beneficiary under a trust, you lose natural love and affection with that trust, because you can't have natural love and affection with a company. However much you might try, it just doesn't work. So there are other reasons why you might not want a corporate beneficiary under a trust. It would have to be, look, notwithstanding you can't do it anyway, you would want to make sure that you weren't doing debt forgiveness and things like that, which would get scuppered.
Yeah, so
that's the point I think you're referring to, Ian.
Yeah, typically we gift assets into the trust, or we gift debt into a trust, and where the trust was holding that asset for the natural love and affection for beneficiaries for whom the settlor has natural love and affection, then the forgiveness of debt wouldn't normally result in debt forgiveness income. But if there's a subsequent distribution to a corporate, which you can't have natural love and affection, then that income comes onto the books at that stage. So we haven't. The other situation used to see it was perhaps where a company had losses and the trust had income, and there'd be an attempt to distribute the income down to the company and to be sheltered by the tax loss. I don't that. You've got that debt forgiveness risk as well. So this is going to be taxed at 39%. So I wouldn't be recommending distributing income as beneficiary income to corporates. If you did want to, just remember that the company would need to be appointed as a beneficiary under the terms of the trust deed, because you can't distribute it to beneficiaries that are not eligible as beneficiaries. So let's look now. We want to spend the next sort of 10 minutes contemplating, well, what's the impact of this 39%, and then we'll answer some questions and answers. So we'll attempt to answer some of your questions. So look, I think one of the interesting facts is if you look at a trust and consider it a savings vehicle rather than a income splitting vehicle, we've got a thing called portfolio investment entities that are taxed at 28%. A portfolio investment entity is a savings vehicle, which is reasonably widely held, which will invest in assets and pay tax based on your portfolio PIR rate, and which is, you know, a marginal tax rate. But the top rate for that is 28%. So there's no change proposed in the legislation to change that pie rate. Kiwis do like a good pie, from 28%. So there, now we've got a massive difference. You've got an 11% difference between trustee income at 39% and pies being taxed at 28%, and no further tax ever paid. You know, a pie is different to a company. Company, if it pays tax at 28%, when you pay the dividend out to the shareholder, there's additional tax to pay up to 33%, and if it's held by a trust, but it's now going to be up to 39%. So an 11% difference. As a trustee, you've got an obligation to, you've got fiduciary responsibilities around the investments. If you're managing a portfolio of shares directly, you're going to be paying tax at 39%. If it's invested in the same portfolio of shares, but it's held in a pie, then it's going to be taxed at 28%. So you need to be careful that you're meeting your investment duties as a trustee in if you're not investing in a pie. And I feel that they're going to be forced to invest in pies, which is creating a bias in your choice of investment. And I remember I've been around a long time, and you know, that sort of bias in the tax system in the early 90s was seen as a bad move when we were moving to a broad-based low rate, because you're getting preferential treatment to certain industries. Your Kiwi saver, please.
I was just going to jump in on that. I'm just interested in the comment that, you know, a trust as a savings vehicle, because if you look at some of the discussions within the tax working group, and also you look at overseas regimes where there are mechanisms in the Act which seek to incentivize saving. So you might have a lower rate, or you might have relief at source if you are putting income into superannuation. So with a lower trust rate, and knowing that, as you mentioned, personal services income, we've got a raft of avoidance and specific legislation which will push personal services income into the hand of the personal service provider. With a lower trust rate, 33 versus the 39, we actually stumbled into a position where trusts as a mechanism to save provided that incentive from a tax perspective, and hopefully reduce the burden on the state for state-funded super in the future. Now, pushing it up to 39%, we've lost that natural ability to shelter savings, not personal services income, in a trust at 33. So that for me is a bit of a shame.
Yeah. Thanks, Mark. Well, I think when you look at a trust, you know, the most trusts, the wealth comes from the growth in the family home, which is obviously a sacrosanct asset. And as it's gone up, the trust can use the sort of equity it's got in the property, the family home, to make further investments. So it's, in a lot of cases, it's not personal services income that's going through trusts in the current environment. It's the assets that the trust own being used to make further investments, whether that's borrowing against the house to invest in a business, borrowing in the house to buy a rental property, borrowing against the house to buy a share portfolio, or whatever. It's I think it is a savings vehicle, and I thought that's part of the reason why they didn't change the trustee tax rate from 39 to 39% when they moved in 2022 to that higher tax rate. So I think don't be lazy with your trust. I think one of the impacts it's going to have is that trusts remain a very good vehicle. They need to be properly run. Obviously, they've been new disclosure rules, new trust disclosure rules, new requirements for financial statements. So if you're having a trust, there's a lot of people that have probably pulled out of trusts and just kept it for the family home and made it a very dormant asset. I think that's sort of maybe cutting your nose off to spite your face, because I think as you generate wealth in that trust for the benefit of your mokapuna, if you like, or for the next generation, you don't want to be lazy with it. And what I mean by that is that maybe you've come to the end of the year, you've done your tax return, and there's income there, and you say, well, the difference between what my beneficiaries are earning and 33% is probably not that much. Say maybe they're on 30% tax rate. Their 3% is not worth the saving. I can't be bothered with distributing it to beneficiaries, so I'll be a bit lazy and I'll pay the 33%. Paying it at 39%, I guess there's a bit more of an incentive there to get the money out to the beneficiaries. So you can see the pushing it out to the beneficiaries may happen. If that's happening, one of the challenges, of course, is then you don't have the money there to reinvest. So do you gift it back? Do you get the beneficiaries to gift it back? Is there going to be an extra bit of paperwork you need to do at year end where you say, hi kids, you can have this beneficiary income, but by the way, I'd like you to gift it back to back to the trust? I don't know. I'm just speculating there.
I'm feeling a bit like one of those annoying flies that are in your ear when you're trying to go to sleep, Ian. So I apologise. But the other side of it is, if you do need the money back, maybe the beneficiary loans it back. One thing to remember is the rules regarding who is a settlor of a trust tightened and widened, such that if a beneficiary has a current account balance of $25,000 or more and is not receiving a fair, i.e. market rate of interest, then that beneficiary can be deemed a settlor of a trust. And as we know, settlors of the trust can be quite unfriendly with our land tax tainting rules, potentially. Maybe other situations where you are looking for other benefits from the tax system's welfare state. So just be careful. Yes, beneficiary income, if it's coming back, what does it mean?
Yeah. Thanks, Mark. I don't mind an annoying fly. We're trying to have a conversation. We're having a conversation on tax, so it's conversations need to be two ways. So you're doing a good job. Look, I think the burning question is: say you're sitting with a company with profits and retained earnings and imputation credits, and we've got in the client base around New Zealand, I'm sure there are lots of companies around who are sitting on 20. We know for a fact that companies have got imputation credits at 28%, and have been reluctant to pay out dividends because of the 5% resident withholding tax that need to be paid to top it up to 33%. Now, there's no change to the proposal to the dividend withholding tax. It's not going to change from 33% to 39%. The reason for that is that there's lots of shares that are held by individuals, not by trusts, and it may be inappropriate to have the withholding tax withheld at 39%. Think of retirees owning a portfolio, maybe on a lower income, and being forced to have withholding tax deducted at 39%, then file a tax return, get it refunded back. So that's a positive news. So now that it's 11%, you're going to pay tax at 39%, because let's say the amount of the dividends you're going to pay out is not going to be able to be spread wide enough through the beneficiaries of the trust. Then will it be appropriate to pay out a fully imputed dividend before 31 March 2024? And will this be seen as tax avoidance? And that's a question I'm putting to you, Mark.
Thanks, Ian. More than kind. This what my immediate reaction when you're talking there, I was thinking, this is a bit mean, isn't it? We live in fear of tax avoidance. There's always extremes with everything, but look, we recall not too long ago the highest marginal rate going up to 39%. Dividends were paid for those companies owned by individuals prior to the rate change, and avoidance crept into the mix again. Look, I would strongly argue against any form of tax avoidance with your vanilla dividend. So look, importantly, I would spin this around. This is actually accelerating a tax liability which otherwise wouldn't have arisen. So rather than it being avoidance, it's the direct opposite. And I could further argue that they must have contemplated this to happen because it happened last time. If they didn't want it to happen, then we should have gone to a split rate year where the trustee rate suddenly changes within a week of the announcement, as we have with Bright Line, etc., to prevent people from planning away from it. So I'd have to say we can't fully discount it, but strongly suggest that it's not avoidance, unless you might be being a bit cute and deciding to pay 5 years of dividends on the 31st of March 2024. As opposed to what would ordinarily be your normal dividend policy, which may happen after the event. So I think it accelerates the tax, and argue strongly not avoidance. But 100% right, Ian, we can't discount it.
Well, we know that the revenue been running an exercise looking at the dividends that were paid out before the last tax, when personal tax rate went up to 39%. With the view to questioning whether dividends paid out was done to avoid tax. It's almost like saying, well, look, a beneficiary and working for families doesn't do an extra hour's work because it takes them into a different bracket and they lose all their entitlements. They're not doing that extra hour's work to avoid losing their benefits. That's a totally different end of the spectrum. So please don't be offended by that example. But I just, not earning income to avoid tax is not a tax avoidance, I'll
enjoy the day when accelerating a dividend is avoidance and not paying a dividend is avoidance.
Well, that's right. The reason that companies are pregnant with imputation credits is they didn't want to pay that top up from 28. And remember, we used to have company tax rate used to be 33. Then it went to 30, now it's down to 28. And one of the questions I've been asked before has been, do you see the company tax rate being aligned to the top marginal tax rate? Maybe in the future you get 36, 36, 36. And I don't think we will see that. I think the company tax rate will have to remain slightly below the Australian company tax rate and at a competitive rate to try and continue to attract investment into the New Zealand we're a capital importing nation. Look, a couple of other points. I mentioned there's no change to dividend withholding tax from 33%. There's also no change to provisional tax. So from provisional tax point of view, you're not being asked to pay more provisional tax because the tax rate is going to go up from 33 to 39. You can still base your provisional tax as a trust on your prior year with a standard uplift, 105 and 110. And the reason being for that is that you're maybe subject to use of money interest from the third instalment, which is usually in May after the March year end. So you should have a rough idea of what your tax you need to pay in that. And finally, the last one, and Mark mentioned the complying trust, that this is really about compliant trusts. So non-compliant trusts have a penal tax rate on distributions. They're taxed at 45%. There's no proposal to change that, but they have looked at it, but they haven't had a chance to assess that. Now, the reason that there's a penal tax there is that non-compliant trusts might be seen as a way of deferring New Zealand tax on certain income, and as a disincentive to doing that, they had this penal tax rate. That 45% was set when the trustee rate was at 33%, and the top personal rate was 33%. So there was a 12% gap. Now there's a 6%. The question is that now still a penal rate or sufficiently penal to stop bad behaviour? I think that might be something that will be assessed over time. I don't think they had the data to be able to do that. Some of the trust disclosure rules and some of the information that's coming through on the new financial statement in the tax returns hadn't been received in time for the regulatory impact statement to be assessed. So our last point is thinking about holding company structures or for commercial investment. So maybe if we can just move to the next slide, we've got a structure here where what we're talking about here is not income that you need to generate out of your trading company to pay for your boat, your batch, your BMW. pay for the private assets that you want to do, you should pay tax at the marginal tax rate on that income. It's very difficult to get it out as income to fund those sort of lifestyles. But if you're lucky enough to be making money and want to reinvest it in other sort of investment entities, our tax structure system has probably been favoured a flat structure over the years, where maybe a trading company might sit to the side, or if it sits under the family trust is the one that invests in the investments. You could now have an investment company to the side, and the challenge here, if you look at a flat structure, is how do you get the profits out of the trading company, or the cash generated out of the trading company, into the investment company without it being a loan? If you lend the money, then it's still that loan could be called up by an unsecured creditor, or a creditor is not covered if the trading company went into difficulty some years later. So typically you'd have to, in a flat structure, have to put it up from the trading company up to the family trust. You're now going to get taxed at 39%. Family trust got to put the money down into the investment company to make investments into other assets that will generate income. So a holding company structure under the family trust might be a better solution for you, or even under an individual. And that's where the wealth that's generated by the trading company, which might have a risk of unsecured creditors or a trading downturn, but when it's paid out, it's solvent and there's no such risk at that time, so the dividend can't be clawed back. If that dividend goes up to the holding company, if it's wholly owned, then it's an exempt dividend and the assets are completely in the holding company and it can make its investments. Or if it's less than wholly owned, it would be taxed, but taxable income to the holding company, but have an imputation credit at 28%, so no further tax to pay. So it's a holding company could be a useful deferral mechanism to prevent that 39% tax being created. So and so you question whether the government will actually collect the extra 350 billion from the change in the trustee rate if these sort of things. So again, got to be a bit careful around avoidance, and maybe Mark, seeing I threw the last avoidance question to you, I can throw this one to you about a change in structure.
Yeah, no, we I was going to say we love avoidance. We don't love avoidance. We mitigate, don't avoid. So, but avoidance as a topic is far-reaching. So you've got to be very careful with restructuring existing operations. Definitely take Ian's point that investments in companies, your investment vehicle of choice to own the shares in a company is naturally probably going to be another company. If we do look to restructure existing operations which might have a family trust owning the company underneath and interpose a holdco, we've got to be careful of the dividend stripping legislation, specific anti-avoidance legislation, whereby you could effectively structure the affairs such that the wealth of, or the value of, the trading company is well, we remove dividends from the tax net. I'll leave it at that. So introducing a holding company can be tax avoidance. We have to be very careful as to what values we subscribe to the shares which are issued to the family trust, etc., to mitigate the avoidance. The other side, so that's an in-operation structure. The other side you can sort of see where companies are not necessarily wholly owned, but you have multiple investors. Not necessarily, maybe you've got 10 investors in Tradeco. Again, holding your interests in a holding company, which might be owned by family trust or yourself individually, regardless, the holding company may provide an absolute tax saving. So, for example, I don't have control over dividends from the Tradeco, but I do want a vehicle that's going to hold the dividends as and when they are derived. So, for example, to hold other investments, as Ian mentioned. But if I pass the dividend up from an entity, from a company which I do not wholly own, I will assume that there's imputation credits attached. So regardless of that wholly owned exemption, that the dividend is exempt, I've got enough imputation credits to offset any tax liabilities in my new holding company. and then I can just leave it there. And I might wait and wait and wait. And it's my investment vehicle, it's my retirement vehicle. And at such point in time as I am retired, I will then start to pay dividends. And those dividends might be less than 180,000 per annum. And therefore I am under the 39% threshold, assuming it stays static. There's an absolute tax saving there by using an intermediary holding company to hold my shares in the trading company. This seems obvious. Clearly not being tested from an avoidance aspect, hence my point earlier, is it avoidance if you don't pay dividends? But look, time will tell as we evolve through this new tax system.
Yeah, I think the other thing is, the holding company is not necessarily panacea for all ills. One of the reasons why flat structures have arisen is that if you sell your trading company, the business of the trading company is sold, the capital gain can get out to the family trust tax-free through the liquidation of the trading company if it's a business sale, business asset sale, or if the shares in the trading company are sold, then it goes to the family trust. If it's in a holding company, then the capital gain is trapped in at that holding company, and it needs to be can only be distributed on a liquidation out, and that might affect the other assets that the holding company has invested in. So not impossible, but just a little bit of extra things. So you need to talk to your BDO advisor and go through that as to whether it's appropriate for your facts and circumstances. So we'll move on to the last slide. We've got a couple of questions which we will address in due course, but I think there's sort of 3 points here, and really we did want to look at a sort of wider reset of the tax system and overhaul. I think what we've seen is over the last 10, 15 years, we've had a real sort of hodgepodge of changes in tax systems, and I think there's time for a complete kind of reset and an overhaul of the tax system. And I think things like the residential, the bright line test been extended 10 years. I find it quite offensive that any other capital gain on a property wouldn't be taxed, but if you suddenly sell your bright line asset within 10 years, it's taxed. And if you own that asset in your own name, it's taxed at 39%. That's a high capital gains tax. And there's lots of other countries where there's a 50%. Let's take Australia, 50% exemption for assets that are held by individuals to get on the capital gains tax rate, or a capital gains tax were formally introduced where a lower tax rate could be applied to 10 or 15%, for example, might be a solution. I know the tax working group looked at it, and it just seems to stick out like a sore thumb, etc. I think the cost of bracket creep, this is the inflation adjusted, the fact that our thresholds for when the tax rates apply haven't changed in, I don't know, 20 years, 2011, when was the last time? Budget 2010, probably, when the thresholds changed. When the inflation was at 1%, it probably wasn't that much of an issue, but now we've got a couple of years of inflation at 4% to 6% to 7%. That's really eating into the tax on that, and I believe that National have announced that they would move those brackets. And my point here is I'm not sort of advocating a political party or a tax system either way, but the challenge is if you don't move those brackets on a semi-regular basis, then the cost when the move is made, because you have to move it at some stage, the cost is much greater, right? Because you have more and more people have moved into higher brackets and tax rates. So a little and often, maybe every 3 to 5 years, would be, I think, a preferred situation. And lastly, just don't underestimate how much data that is available and shared between different tax jurisdictions, and that's available through the tax system to the government itself. And Mark, you just might want to comment about the new disclosures that are happening.
I can quickly. My immediate thoughts were when you're talking about the bracket creep and the last time we had a change. I think, and I could be wrong, but I think the sales of cheese rose commensurately with the bracket creep because the change, because it was enough to buy a block of cheese. Is that when that happened?
I can't remember.
No. So the big data and disclosure, look, we're always hungry for information. We have a new disclosure requirement for individuals, IR 1261, which requires individuals to disclose all sources of foreign income, quite a bit of information, where it's from, what it is, what tax credit, etc., the amount, the gross amount, the tax credit that accompanies it. It's going through some teething issues at the moment. I think we're obligated for the 31/3/23 tax year, I think, but it hasn't quite addressed issues around large foreign investment fund investments or managed funds. How do we deal with those? Do we have to break them up? Does the form go wide enough? If we are multi-jurisdictional, we've got hundreds of investments, etc. It could be quite an onerous task, unless we might be lucky enough to perhaps pick the report up from our investment provider and just supply it to Inland Revenue without having to double down. But that's still a wait and see. Look, these rules as well are Big Brother. The eye is on you. They're watching you. We do have common reporting standards, FATCA, etc., for the US, which is really information sharing between jurisdictional revenue authorities. They will be using that information and then comparing it to what you are disclosing in your individual tax returns as part of that disclosure mechanism. Difficult to see how they're going to marry up a disclosure on FIF income and perhaps a dividend from a foreign company when the FIF income is completely different from the dividend received. For example, we might be under fair dividend rate, which just takes 5% of the open market value of the company, which has no bearing towards the dividend yield during the year, or the comparative value is your natural default. If you're not using FDR, comparative value looks at pretty much what economic value you've had out of holding that investment over the year, and again, doesn't necessarily bear resemblance to the dividend. So IR 1261, it's yet another disclosure headache for individuals. Yeah.
Look, I just want to quickly touch base on some of the questions that we've got now. Lee Matthews asked if there are any tax incentives of substance in regards to assisting companies moving towards ESG responsibilities. I know we advertised that we were going to talk about tax and ESG. Currently, there are not those types of tax incentives, and we were going to explore what other countries were doing. And in that regard, BDO Global has run a worldwide survey on ESG initiatives in different countries. We're going to bring that into our next seminar, which we may have more quickly than we planned. We've traditionally done 2 a year. I think we might have enough material for 3 a year this year. So we will bring in something on ESG and we'll sort of publish the results of that BDO Global survey. So apologies, Lee, that if you signed up specifically to hear that ESG comment today, but we found the trustee rate just took up too much, there was so much of interest. Mark, any other questions?
I think you can buy a job lot of e-bikes and e-scooters and not have FBT.
Yeah, but they've got to be bought for the purpose of travelling to work.
Sorry.
Yeah, so I do wonder what your health and safety response is if the person has an accident on the scooter and you bought the scooter for them. But no, look, it will. That's a helpful move, but it's not getting you to the ESG sort of incentives that we think need to be applied to get that shift. So we'll supply that. Look, there's been a couple of comments on the dividends and avoidance, and I think there is it might be a question over whether the dividend is paid in cash with the company solvent or whether it has to be dealt with in credit, and will that change the avoidance kind of flavour of that? Similarly with the holding company structure, the dividend stripping provisions that Mark discussed is certainly something that needs to be considered. But the anti-dividend stripping has been about selling your asset across, creating a debt that you can at market value. The sell across is debt or share capital, which can be bought back at tax-free at some point in the future. Perhaps you could set a holding company in where you simply gift it across and transfer the shares to the holding company, and maybe that gets round it. And there was one last question, Mark, I haven't covered. Can you? picking up?
There was something on prov tax. I think you dealt with that in the seminar.
Well, I think the point with the prov tax was that actually the change in tax rate might take you into the provisional tax regime if you weren't in it before, because suddenly you're going to have RIT at higher level at 39% and maybe over that 60,000 for the use of money interest. So, and do we see more assets being held in company structure? Well, I think that just depends on everybody's facts and circumstances, but I would think that it will drive people into companies, subject to that difficulty of getting capital gains out of a company once it's been realised.
Not private assets though.
Not private assets, no.
No.
Keep your private, pay your tax and use your funds that you get from the tax to
keep your private assets to yourself.
Yeah. And on that note, look, thank you everybody for attending this webinar. It is recorded. It will be put up on the website if you want to revisit it. If you've got any questions going forward, please contact your BDO advisor or contact us through the website and we'll try and address those questions. The legislation's in front of Parliament for discussion. I don't see it changing, but we do have, we haven't seen an election, any announcements from if there was a change of government, whether this would be reversed or not. But thank you for attending. I know it's you've got 1 hour CPD potentially, if that's important to you. But we thank you for your attendance today. I think so. We'll be in touch about our next webinar. All the best. Have a good day. Ah.